Hey there, ready to dive into something that might just change how you view the stock market? Today, we're tackling the relationship between monetary policy and those sometimes mystifying stock market swings. We're even going to explore something called equity market risk premiums.
Yeah, that's basically the potential extra return you can expect for taking the risk of investing in stocks.
Exactly.
It's a connection a lot of people feel like they should understand, but the jargon can get pretty thick.
Yeah, for sure.
Luckily, we've got a fascinating research paper to guide us through all this.
Perfect.
It cuts through the complexity and delivers some surprisingly clear insights.
So whether you're prepping for a big meeting, or just trying to be a more savvy investor, or simply love geeking out on this stuff, stick with us.
Absolutely.
You might be surprised by what you discover.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
And we're going to start with something you've probably heard about, but maybe not fully grasped. The Taylor Rule.
Okay, that does sound a bit intimidating. Break it down for us. What is this Taylor Rule and why should we care?
Well, imagine the Federal Reserve, the central bank here in the U.S., as a chef trying to cook up a healthy economy. The Taylor Rule is like their trusted recipe, helping them adjust interest rates based on two key ingredients: inflation and economic growth.
So it's like a guide to keep the economic oven at just the right temperature.
Exactly. And what's interesting is that the research points out how since the 1980s, central banks have become even more focused on that inflation ingredient. They're really determined to keep prices stable.
That makes sense. No one wants to see their money buy less and less over time. I know I've definitely felt that pinch at the grocery store. But how does this all connect to the stock market?
Here's where it gets really fascinating for you as an investor. Those interest rate changes driven by the Taylor Rule and monetary policy ripple through the entire economy. They ultimately impact all kinds of asset prices, including the prices of those stocks you might be holding in your portfolio.
So it's not just about picking the right companies, it's about understanding these bigger forces that are at play in the background.
You got it. And the research really emphasizes that both the predictable moves the Federal Reserve makes based on the Taylor Rule and any unexpected shifts they make play a huge role in shaping overall financial conditions. Economists are increasingly seeing this as a key driver of what happens in the market.
Okay, that's intriguing. It makes the market seem a little less random and a little more like something you can actually get a handle on.
Precisely. But there's another piece of this puzzle we need to explore, something called the liquidity premium.
What exactly is a liquidity premium and why should it matter to me?
Think of it this way. Imagine you have two valuable items. One you could sell in an instant, and another that might take weeks or even months to find the right buyer for. You'd probably demand a higher price for that less liquid item, right?
Yeah, I'd want to be compensated for the hassle of potentially having to hold on to it for longer.
Exactly. And that, in a nutshell, is the liquidity premium. Investors apply the same logic to assets like stocks. They want more return for holding assets that are harder to sell quickly.
So if I'm understanding this correctly, the ease with which you can buy or sell something actually impacts its price.
You got it. And wouldn't you know it, monetary policy plays a role here too. When the Fed adjusts those interest rates, they're influencing how easily money flows through the system, which directly affects that liquidity premium. The research actually suggests that measures of this liquidity premium can be just as good at predicting future market returns as monetary policy itself.
Okay, I'm starting to see how all of these pieces fit together. Interest rates, monetary policy, liquidity premiums, it's all interconnected. Now let's get to the heart of this research paper they've developed what they call a three-factor model that claims to predict those equity market risk premiums we talked about earlier.
Right.
That sounds impressive, but also maybe a bit intimidating. What are these three magical factors that we need to be paying attention to?
Well, the great news is that at least one of these factors will probably sound familiar. The first one is, of course, monetary policy measured using something called the FFR-FIT. It's basically capturing those predictable actions of the Federal Reserve based on the Taylor rule, like we discussed earlier.
So factor one is all about how the central bank is reacting to the economic climate at any given moment. What about factor two?
Factor two is the scaled stock market price. Think of familiar metrics like price-to-earnings ratios or PE ratios, which look at stock prices relative to company earnings.
Yeah.
You've probably heard financial analysts talk about those all the time.
Oh yeah, PE ratios are definitely a staple of financial news. It makes sense that it would be a major player here. So we've got the central bank's moves and the relative value of the overall market. What's the final piece of the puzzle?
The third factor is stock market variance. This one's all about how much stock prices are fluctuating up and down. It essentially captures the level of uncertainty or volatility in the market.
Okay, so we've got the Fed's actions, the market's valuation, and how much it's bouncing around. And the research suggests these three factors combine to give us a powerful prediction of market risk premiums.
Exactly.
I have to admit, I'm already starting to think about the market a little differently. Before, it all seemed so random, but now I'm seeing these underlying patterns.
That's the beauty of this research. It starts to reveal the order behind what can often seem chaotic. And here's another interesting tidbit. You might think you need super complicated models to make accurate predictions, but this research actually found that simple models often outperform those super sophisticated ones. It's not about data overload, it's about having the right information.
So quality over quantity, that's a relief. Do they give any specific examples of that in the paper?
They do. In their testing, their three-factor model actually beat out some pretty fancy machine learning techniques.
Wow, that's surprising. But I guess it makes sense. Sometimes the most elegant solutions are the most effective. Before we move on to those interactions, though, I'm curious. Does this model only work in the U.S.? What about other countries?
That's a great question. And here's where it gets even more interesting for you if you're invested globally. They found that this model works well for predicting stock returns in other developed countries, too.
So these relationships between monetary policy and market behavior aren't just a U.S. phenomenon.
Not at all. It seems like these are fundamental dynamics at play across multiple economies. But before we get too far ahead of ourselves, there's one more important concept we need to address: monetary policy shocks.
Okay, let's unpack that. What are monetary policy shocks, and why do they matter for someone like me who's trying to understand the market?
Think of monetary policy shocks as those unexpected twists and turns in the economic story. Remember how we talked about the Taylor rule guiding those predictable Fed moves? Well, a monetary policy shock is when the Fed deviates from that expected path. It's like they suddenly slam on the brakes or hit the gas when no one was expecting it.
Sounds like that could definitely throw a wrench into things. How do those shocks impact the market?
You're right, they often do introduce some volatility. But the research found that while these sudden moves can impact asset prices in the short term, their main effect is actually on interest rates, not those market risk premiums we've been discussing.
So those shocks might cause some temporary turbulence, but they don't completely upend the model's predictive power in the long run.
Exactly. It really reinforces the idea that understanding the underlying predictable forces driven by monetary policy can give you a valuable edge when navigating the market. It's fascinating, isn't it? It really highlights that while unexpected events can shake things up, those predictable Taylor rule-driven actions of the Fed can provide a solid foundation for understanding the market's movements.
It definitely makes me feel like I can at least start to make some sense of all those headlines about the Fed and interest rates. It's not just abstract economic theory, it's directly impacting my investment decisions.
Exactly. And speaking of those decisions, there's a really important takeaway from the research that challenges some common assumptions about how to predict stock market movements. You see, there are a lot of people out there who believe you need these incredibly complex algorithms or insider information to beat the market.
Yeah, you always hear about those hedge funds with their supercomputers crunching mountains of data. So what's this research saying? Is there a simpler way?
The research actually found that simple models like the three-factor model we've been talking about often outperform those super sophisticated approaches. It really underscores that it's not about data overload, it's about identifying the right information and understanding those key relationships.
So it's not about trying to predict every tiny detail, but focusing on the fundamental forces that are driving things behind the scenes. That's actually pretty reassuring.
I'm glad to hear that. It means that with some knowledge and careful analysis, you can gain a much better understanding of the market and make more informed decisions.
Okay. I'm definitely intrigued by this three-factor model. But you mentioned earlier how those three factors interact in interesting ways. Can you elaborate on that a bit? How do those interactions actually play out in the market?
Absolutely. One of the most interesting findings is that when that fitted federal funds rate metric, or FFRFIT, is high, it tends to coincide with lower scaled market prices, like lower PE ratios. Remember, a high FFRFIT suggests that the Fed is likely to tighten monetary policy soon, which can make investors a bit more cautious, leading to those lower prices.
That makes intuitive sense to me. If you think interest rates are about to rise, you might not be willing to pay as much of a premium for stocks.
Yeah.
But what about market variance, that third factor? How does that fit into the picture?
Well, the relationship between FFRFIT and market variance is actually one of the most surprising findings of the research. While they tend to move together in the data, meaning when one goes up, the other tends to go up as well, their effects on those equity risk premiums we talked about earlier are actually opposites.
Wait, so even though they're correlated, they're pushing risk premiums in different directions. That's a big counterintuitive.
I know, right? It was definitely an aha moment for me when I first read the research. But that's what makes this research so valuable. It challenges our assumptions and reveals these unexpected relationships that you might not notice otherwise. Essentially, it's suggesting that the market responds to both predictable monetary policy actions and the overall level of uncertainty in unique ways.
I'm starting to realize that there's a lot more nuance to the market than I initially realized. It's like peeling back the layers of an onion. Each new piece of information reveals a new layer of complexity.
I love that analogy. And just when you think you've got it all figured out, there's always another layer to explore.
I'm ready for the next layer. I'm curious, did the researchers look at how this model performs during different economic conditions? Does it hold up during times of economic boom and bust?
They did, and that's actually one of the strengths of this model. Their analysis showed that it remained robust across different economic states. It consistently predicted market returns regardless of whether the economy was expanding or contracting. So whether we're in a period of rapid growth or things are slowing down a bit, those core relationships still seem to hold true.
Okay, that's really impressive. It suggests these relationships are capturing something fundamental about how the market operates, something that goes beyond those short-term economic fluctuations.
Exactly. It's another piece of evidence that supports the idea that these factors are tapping into something truly meaningful. And that brings us to another fascinating aspect of this research. Remember how we talked about the model's simplicity? Well, the researchers actually went head-to-head testing their model against some of those popular machine learning techniques we mentioned earlier.
Yeah, those super complex algorithms that everyone seems to be raving about. So how did the three-factor model stack up?
Well, you might be surprised to hear this, but the three-factor model, that relatively simple approach, consistently outperformed those more intricate machine learning models, especially when it came to making predictions about future market behavior.
Wow, that's really remarkable. It really does seem like sometimes less is more when it comes to understanding the market.
It certainly challenges that prevailing notion that complexity is always better. In this case, the researchers focus on understanding the underlying economic relationships rather than simply crunching numbers, seems to have given them a real edge.
That's such a valuable reminder to focus on the fundamentals. Sometimes we get so caught up in the latest technology or the fanciest models that we forget about the core principles that are driving things.
I think that's a really insightful observation, and it has implications far beyond the world of finance. It encourages us to step back and ask ourselves, what are the fundamental drivers at play here, rather than getting lost in a sea of data or complexity?
I love that. I'm definitely going to keep that in mind as I navigate the market and life in general. But before we wrap up, I want to circle back to those monetary policy shocks we talked about earlier. You mentioned that they can introduce volatility, but their primary impact is on interest rates rather than those market risk premiums. Did the researchers dig into those shocks in more detail? I'm curious to know how those sudden shifts in policy actually played out in their analysis.
They did. They were specifically interested in seeing how their model performed during those periods of unexpected policy changes. And what they found is really fascinating. Even in the face of those shocks, the model remained remarkably resilient.
So even when the Fed throws a curveball, those core relationships still hold up.
That's right. It's like those underlying forces are so powerful that they can weather even those unexpected storms. And remember those measures of liquidity we discussed earlier, things like how easily assets can be bought and sold. Well, the researchers found that those liquidity measures, which often move in tandem with monetary policy actions, can also provide valuable insights into future market behavior.
Wow, it's amazing how everything is interconnected. But I have to admit, this is a lot to take in. What would you say is the most important takeaway for listeners so far? What's the one thing they should walk away from this deep dive remembering?
I think the biggest takeaway is that monetary policy, something that often feels very distant and complex, has a direct and measurable impact on your potential returns as an investor. It's not just about luck or random market fluctuations. There are underlying forces you can start to understand and even anticipate.
That's a powerful insight. And it definitely makes me want to pay more attention to those announcements from the Fed. I'm starting to see them in a whole new light now.
That's great to hear. The more you understand those forces, the better equipped you'll be to make informed decisions and navigate those market ups and downs.
Now, remember you mentioned earlier that the researchers didn't just stick to one method of analysis. They really wanted to test the robustness of their findings. Did they explore any other interesting approaches?
Right. They went above and beyond digging into historical data and trying different analytical techniques. One really interesting thing they did was test how the model performed under different monetary policy regimes. Specifically, they looked at periods that economists would classify as hawkish versus dovish.
Okay, I need a quick refresher on those terms. What do hawkish and dovish mean when we're talking about monetary policy?
Imagine you've got two different approaches to keeping the economy running smoothly. A hawkish stance is when the central bank is laser-focused on fighting inflation, even if it means potentially slowing down economic growth a bit. They're quick to raise interest rates to keep prices in check. A dovish stance, on the other hand, is a bit more tolerant of inflation. They prioritize economic growth and employment and are a bit more hesitant to raise rates.
So hawks are inflation fighters and doves are growth promoters.
That's a great way to think about it. And what's remarkable is that the three-factor model performed really well in both hawkish and dovish regimes. It consistently predicted market returns even when the Fed's overall approach to monetary policy was shifting.
That's a strong indicator that these core relationships hold true even when the economic environment is changing. It gives me more confidence in the model's ability to provide valuable insights regardless of what the Fed is doing at any given moment.
You got it. It really underscores that these variables are capturing something truly fundamental about how the market behaves, something that transcends those short-term policy changes.
It's also really reassuring to know that the researchers went to great lengths to account for any potential data limitations. They were very thorough in their approach, using robust statistical techniques and even incorporating alternative measures for certain variables just to make sure their findings were as solid as possible.
Absolutely. For example, remember how we talked about that stock market variance factor? Well, they didn't just rely on one measure of that. They explored both realized variance, which looks back at historical price fluctuations, and options implied variance, which leverages market data to estimate future volatility. They even incorporated something called a Midas model, which analyzes multiple timeframes to get a more comprehensive picture of volatility. They really tried to cover all their bases.
That's impressive. And I'm guessing that even with those alternative measures, the core findings of the research remain consistent.
That's right. Even when they used different ways of measuring things, the three-factor model kept demonstrating that it could reliably predict those equity risk premiums. It's a strong testament to the robustness of their research and their commitment to finding those deeper patterns that drive market behavior.
It makes you wonder if we often make things more complicated than they need to be when we're trying to predict the market. The fact that their simple model outperformed those complex machine learning techniques is really quite remarkable. Is that a common finding in financial research?
It's definitely gaining more attention. There's a growing realization that sometimes simplicity and clarity can be more effective than complexity and obscurity. In this case, the researchers focus on understanding the underlying economic relationships rather than just throwing everything at a supercomputer. Seems to have really paid off.
It's a powerful reminder that sometimes the most elegant solutions are also the most powerful. It makes me wonder if we often overcomplicate things in our quest for greater accuracy or insight.
I think that's a profound observation, and honestly, it applies to so much more than just finance. It encourages all of us to step back and really think about what's driving things at a fundamental level rather than getting lost in a sea of data or overly complex models.
Well said. I feel like this deep dive has really been eye-opening. We've learned so much about how monetary policy and the stock market are interconnected, the power of simple models, and the importance of understanding those fundamental forces that are shaping market behavior.
It's been a pleasure exploring all of this with you. Hopefully you're walking away from this with some valuable insights that will help you navigate the market with more confidence.
Yeah, absolutely. We've decoded the jargon, uncovered those sometimes hidden relationships, and hopefully sparked a lot of curiosity along the way. So as we wrap things up, we want to leave you with one final thought to ponder. How does this knowledge change your perspective on those seemingly random market fluctuations? Are you feeling more informed, more empowered to make sound investment decisions? We hope so. And remember, knowledge is power. Don't be intimidated by complex financial topics. There's a wealth of information out there that can empower you to make informed choices. So keep exploring, keep learning, and keep diving deep.